looking at these wildly fluctuating candlestick charts, you're bombarded by data streams and volatile price action that whip up and down minute by minute. Technical analysis flags short-term entries, and interest rate differentials show you where speculative capital is flowing today. But try to project those signals out over 2 or 3 years, and they lose their predictive power. A major currency pair can float in deeply overbought or oversold territory for months or even years. When that happens, standard oscillators break down into noise. So, how do you look at an exchange rate and know mathematically if it is genuinely mispriced or if you're just looking at a temporary blip driven by market sentiment? To figure that out, you have to close your trading terminal and look at what those currencies actually buy in the real economy. You need a metric that cuts through the daily chaos and points directly to a currency's long-term economic center of gravity. Economists use a concept called the law of one price. It assumes a theoretical global market with no trade barriers, where identical goods cost exactly the same everywhere. If a laptop costs $1,000 in the US, it should cost the equivalent of $1,000 in Japan after converting the yen back to dollars. If not, an arbitrage opportunity exists, and trading volume would force the exchange rate back into balance. This is the logic behind the famous Big Mac Index. By comparing the price of this standard burger in different countries, you get a rough estimate of global parity. But institutional traders don't build portfolios around burgers. A single product is heavily distorted by local taxes, real estate costs, and labor wages. This represents the major flaw in absolute purchasing power parity. You can't stick a local haircut in a shipping container and export it to close a price gap. To get a usable metric, serious traders rely on relative purchasing power parity. Instead of tracking single items, this model uses broad consumer price index data to track overall inflation. Relative PPP doesn't look for absolute price equality. It measures the change in purchasing power between two competing economies over a specific period of time. This visualization shows how we calculate this for the euro against the US dollar. We start by pulling a baseline exchange rate from exactly 5 years ago. Let's use 1.1200. Then we map the cumulative inflation of both economies over those 5 years. We apply the Eurozone's 15% cumulative inflation against the United States' 20% cumulative inflation. Because the US experienced higher inflation, the dollar lost purchasing power faster than the euro. Applying the relative PPP formula yields an implied fair value of 1.0733. When you place that calculated baseline next to today's live market rate, you immediately quantify the exact percentage a currency is overvalued or undervalued. If the math gives us a specific fair value, you might expect a live market to snap to that exact price immediately. It rarely does. Moving goods across oceans cost money. Global tariffs, customs fees, and physical transit expenses create a permanent wedge that prevents prices from perfectly equalizing. Then you have financial friction. Billions of dollars in speculative capital move instantly across borders, chasing higher yields when central banks adjust interest rates. That speculative capital acts as velocity, easily pushing a currency pair out of its standard orbit. PPP, on the other hand, is the gravitational pull constantly trying to drag it back. A long-term deviation doesn't mean the PPP formula is broken. It measures the tension of a stretched rubber band. The further it pulls from fair value, the harder it will eventually snap back. PPP is a strategic overlay. You cannot use it as a tactical entry signal to execute a trade on a Tuesday afternoon. Instead, you use it to validate your directional bias. If your technical analysis flags a buy signal on a pair that your PPP calculation shows is deeply undervalued, you build institutional-level conviction for that trade. This data directly informs your position sizing. When you hold a pair mathematically proven to be stretched 20% past its fair value, you can justify setting wider stops and holding the position for the long term. It also gives you clear mean reversion targets. Carry traders use this exact calculation to weigh their long-term exchange rate risks against the daily swap payments they expect to collect. Overlaying macroeconomic gravity onto your standard technical analysis is the step that turns a reactive chart watcher into a strategic investor. Mastering purchasing power parity means you can confidently ignore the daily market noise and lock on to a mathematically proven baseline. Deepen your fundamental analysis with FXNX's institutional-grade economic data. Join NX1 today to execute your long-term strategic views with zero